If you want the secret to getting venture capital sized returns, then you need to understand these 5 rules that venture capital investors live by. And yes, you're going to have to take some chances, but the rewards could be 10,000% returns or even more. But of course, venture capital investing is risky, and many of the startups they invest in never make it. And the VCs who took the bet could lose it all. Now, I'm sure you've heard that, the more risk, the more reward. But it doesn't have to be that way. You see, venture capitalists have a strategy that they use to make sure they always make money. And in this video, I'm going to break it down for you. I'm going to show you how you can apply their exact strategies into your own investment portfolio so you can swing for the fences without the risk of striking out and losing the game. So stay tuned. Hey, welcome back. My name is Mark Moss, and today I want to give you the strategy that venture capitalists use to make huge returns in risky companies, but without all the risk. Now, I'm just going to go ahead and just jump right into this. I'm going to break it down into 5 easy to follow steps. But before we begin, if you can, just click that like button real quick. Also hit that subscribe button and the bell notifications. You're notified every time I put new videos out. All right, so let's go ahead and just jump right into it. So rule number 1 is invest into the trends. Now, when I think about venture capital, I think about Silicon Valley, maybe because I'm in California, but I think about Silicon Valley. I think about computers. I think about social media. I think about data storage, things like that. Obviously, now there's things like virtual reality, artificial intelligence, etc. And so when you look at that, you can see that they all move to invest into these trends. They invest into trends that are new, trends that are growing, that have this huge tailwind behind them. But it doesn't have to only be technology. So for example, right now, the economy is in shambles, right? Of course, the central banks around the world are printing more money than we've ever imagined at levels like we could never even believe. I think they've printed over $6 trillion in 6 months, and that's just in the US alone. And so the trend tells us that that's going to continue, all right? The sickness, it's still around. We still have that. We're still dealing with that. Economies are still shut down. Some are re-shutting down. Countries are re-shutting down even more, locking down again. And when that happens, economies get worse. And then, of course, more money printing is going to happen. It's going to continue. And so I think as more money printing happens, buying real things, real assets like gold, they're going to be good. And gold has been going through the roof. Now, I've even gone as far as to call this on other videos, I call it the trade of the decade. It's that big of a trend. All right, so follow the trend. Now, rule number 2 is that venture capitalists look for what I call asymmetric bets. All right, so what they do is they look to make huge returns, but without taking on huge risk. All right, sounds great, doesn't it? So let me show you how. So like I said, I call these asymmetric bets, which basically means that they're asymmetric. So they have more upside than they have downside. So we can do this when we have asymmetric information. All right, when I know something that everybody else doesn't know, as asymmetric information, then it allows me to have that asymmetric return. So it could be either like a brand new trend that most people don't even know about yet. It could be something that most people don't believe in yet, like Bitcoin. But asymmetric information leads to asymmetric returns, like I said, and not just big returns, but also big and also safer returns. Now, to kind of illustrate this, one of the most successful, one of the most well-known billionaire hedge fund investors of our time, Paul Tudor Jones, PTJ. Paul Tudor Jones, he has a rule that he calls the 5-to-1 rule. And basically what it is, the 5-to-1 rule means that he's only willing to risk $1 in order to make 5. All right, so that's an asymmetric return, a 5 times upside with a 1 time downside. That's his rule 5-to-1. So by using this strategy, it allows Paul Tudor Jones only need to win 20% of his bets. He can win only 20%, or, basically he could be a complete idiot. A complete imbecile. He could be wrong 80% of the time and still not lose any money. All right. This is one reason why I love to invest into junior gold miners. Right. I love gold, but I love to invest into junior gold miners because if I spend just a little bit of time doing my due diligence, a little bit of time doing my research, then I can easily find, well, maybe not so easily, but I can find information, what I call, again, asymmetric information, that the majority of people just don't know yet. They're not digging in, they're not paying attention, and so they don't know that. So for an example, like in July, when the price of physical gold was just starting to take off, I mentioned in a YouTube video, I'm going to link it right here, in July, I mentioned a gold and silver miner named Callinex. And at the time, I saw that they were releasing some really good information. First, on June 4th, it announced the discovery of silver, zinc, and lead at this Nash Creek project. Then on June 15th, the company announced more results of their exploration, expanding the potential size and showing higher silver grades that surprised a lot of people in the market. Now, what I saw was these were very important developments. And since the area isn't known to host, high concentrations of silver, it seemed like it was pretty important. But the average retail investors, they weren't seeing this information. So at the time when I mentioned it in that video, it was only $1.29. And since then, it's been up about 140%. Now, right now, it's down a little bit since I mentioned it in the video. It's up about 77% since I mentioned it. And that's just because gold has pulled back and it's still down a little bit. But my point is, that's the power of asymmetric information. I was able to find that, and most people just weren't aware of that. All right, now, rule number 3 is to diversify, okay? Now, I know some people say diversify, some people say Warren Buffett says don't diversify. Venture capitalists diversify. Let me explain. So, like I said, they have to diversify their positions because they understand that these types of small companies that give them those 5-to-1 returns, they're risky, right? And so in order to manage that risk, they have to diversify, like Paul Tudor Jones, PTJ. He has the 5-to-1 rule. So they know that if they, fail a couple of times, if a few of them fail, the ones or the few that do make it are going to more than make up for any losses, plus give more returns. So like I said, in that 5-to-1 ratio, 80% of those projects could fail and you could still make a profit. So, when it comes to junior gold miners, as much as I like them, I'm not going to put all my money into one of them because that would be too risky. Now, I could come out looking like a genius, but the chances are I'd probably coming out looking like an idiot. And I don't want to take that. Even if I were to win big, it wouldn't be worth the risk that I was taking. So instead of buying one junior miner, I buy 5 junior miners. Maybe I want to buy 10 junior miners. Then that way I can diversify my risk. And of course, like I said, give myself a better chance to win big. So like last month, I mentioned a new gold miner. It was called Great Thunder Gold. And again, I think that one also had some really good asymmetric news that comes out. That's why I like to play in that space. I can find that. They announced that they had acquired mining claims right next to some of the best mining projects in the mining region of Quebec in Canada, and it was named the Detour Lake District, which hosts the Detour Lake mine. This is the second largest gold producing mine in Canada. And on top of the location, they also have one of the most successful gold investors of all time as a shareholder. In fact, Mr. Eric Sprott, he's a 76-year-old self-made billionaire in the gold mining space. He's actually one of the largest shareholders of Great Thunder Gold. Now, I added that position to diversify out our risks. And as of today, just in a couple of weeks, I think we're up about 15% on that position, even though gold has still been in this kind of like I'd say a consolidation pattern, right? It's trying to regain its footing, after kind of getting knocked down a little bit. All right, now rule number 4 is that you want to average in on your positions, okay? So you want to diversify positions, but then you want to average in. Now, this is a super, super important rule that venture capitalists use, and it really fits in hand in hand with rule number 3. So we diversify, but then we don't go all in, we average in. So let me explain how that works. So if I had $10,000 and I decided to go into 10 different companies, then basically I'd be putting $1,000 into each of the 10 companies, right? But the thing is even though I committed to put $1,000 into each of the 10 companies, I wouldn't put in the full $1,000 just yet. Instead, what I would do is I'd put in only a partial amount. Let's say of the 1,000, I'm only going to put 300 in at first. And then as they start making progress, I would add more money. When they reach certain milestones of progress or whatever, then I would just keep adding. I'd keep putting more money until I was fully invested into that position, until that full $1,000 was there. Now, I know what some of you might be thinking, that why would I do that? Because I'm going to be paying more each time I go in. So I'm paying more and more and more with each new round of investments. And if you think that, Well, you're right, I would be, but that's not the point. The point is that I'm limiting my risk. So let's say that the company doesn't hit their milestone. In the gold miner, let's say they don't hit that discovery, something like that, whatever, something bad happens, they go belly up, whatever, well, then I've only risked a small part of the money. I haven't risked that whole position. So of course, if it works out, my returns might be less if I invested over time, averaged in, as opposed to investing the whole thing up front. However, my risk is also much lower, and that is the whole goal. The goal is to get the best returns with the lowest risk, with the lowest amount of risk possible that I can take. So like the example I gave of Callinex earlier, like I said, I had really good asymmetric information, but there's also a lot of assumptions there, right? There's still also unknowns. They're expecting to hit these different things and whatnot, right? So at the time, even though it looked like I had good information, I didn't want to go all in. But then now they're coming out with more information. So for example, they just had a new discovery. Callinex announced that their rainbow discovery, which is made up of 2 high-grade copper, gold, silver, and zinc lenses at the Pine Bay Mountain Project. The CEO of Callinex, Max Porterfield, said in a release that the 2 high-grade copper, gold, silver, and zinc lenses discovered suggest we are at the early stage of substantial discovery in Manitoba. And we believe the rainbow discovery has the potential to provide a bright future for Flin Flon and our shareholders. And so that news, they've found a new discovery, which means really big things. I didn't know that at the time, so I invested a little bit. But now that they have more news, they have more discoveries, well, then that shows me that they're reaching more development, they're meeting more of their milestones, and so it takes some of that risk out of the bet for me, and now I can average more of my position into that. So yes, of course, I'm paying more today than I did when I first mentioned it back in July, but it's worth a lot more for me because of the less risk that I'm taking, all right? So you have to understand it's not always about the maximum return, it's about a risk-adjusted return. And by averaging in, I'm taking out that risk, all right? Now, the final success rule, number 5, is having a long-term perspective. So the 5th final rule is basically we just have to have a long time frame. We have to look at this. We have to look at it with a different perspective. And venture capital funds, they usually have about a 7 to 10 year time frame. I'm invested into this new private equity fund, and it has a 5-year time frame. So what that means is that my money I put into that, it's locked up for 5 years. I can't get that money back. Now, why 5 years? Why 7? Why 10 years? Why do they have those time frames? And the answer is because that's how long it takes for new projects and, of course, for the trends that they're writing to be developed and to play themselves out, right? You can't make huge returns, especially on huge trends in days, weeks, or months, right? Like I said at the beginning, and I've said in other videos, the money printing that we're seeing right now and we're going to see over the next few years are going to push investors into hard, real assets, gold, Bitcoin, commodities, real assets, things like that. I'm calling it the trade of the decade. Not the trade of the day, not the trade of the month, not the trade of the year. I'm calling it the trade of the decade. All right. So it takes time and you have to have that right perspective. So there you have it. Those are the 5 rules that venture capitalists use to make huge returns. And you should try to use them for your own portfolio's investments as well. Now, if you'd like to see a list of all the gold companies that I've mentioned publicly on YouTube, check out the link in the description. All right. I put it together because I know a lot of you have been kind of paying attention to this. People have been asking for it. So in the link in the description, I have a list of all of the positions I've mentioned. But just note, I want you to know, please, these are not the companies that are in my private member group inside my tactical asset report. These are just the ones I talk about publicly here on YouTube. So I'm not recommending them. I've used them for instructional purposes only. In the tactical asset report, which is my private investment newsletter, there I do write actual buy and sell recommendations for my members. But of course, like I said, these are just for informational purposes only. All right. Even though they have been doing really good, as you'll see when you download that spreadsheet at the link down in the description, especially if you would have taken some profits on some of them while they are kind of up at their peak before they dipped off. But of course, this is a long-term play. Gold's going to shoot back up, and I expect all of them to do very well. So again, check out the link in the description. Now, that's it. Like always, please give me some thumbs up on this video if you like it. If you don't like the video for some reason, I don't know why, give me some thumbs down, but that's okay. Tell me in the comments why that is. Try to respond to as many of them as I can. And that's all I got to say right now. To your success, I'm out.